Thanks a lot for this very insightful discussion. And good morning, everyone. My name is Quentin. I'm with Deep Sky. We are a director capture company based in Montreal and operating in Canada. Director capture is the process of using machines to capture carbon from the atmosphere and permanently sequester it in the ground. What is special about Deep Sky is that we don't develop technology. We work with the 150 director capture companies, and we deploy the ones that are the most efficient and most cost-effective. We've raised about $100 million since being created the last 3 years, and we're now getting ready for Topco Series B, but also some project financing. So if you're interested in discussing climate tech, director capture, participating in financing opportunities, or visiting the only operating facility in North America that's doing director capture, which is based in Calgary, Alberta, please don't hesitate to reach out. Again, my name is Quentin, working with Deep Sky. We're now going to move to the next panel, which is a very interesting conversation about supporting entrepreneurs for funds. And for this, I'm going to welcome Anil Achyuta, Richard Wang, and Paul Lambert. Thank you very much.
Over there. Where should I go? Here? All right, here. Yeah.
Okay.
Right.
I promise you I'm not gonna be texting. My questions are in this. How's everyone doing?
Great.
How is everyone doing?
Great.
Are you up?
Yes.
Okay, good. We're gonna keep this pretty simple and honest. Everyone here has heard investors say they're value added. Sometimes that's true, sometimes not really. Sometimes it's destructive. So today, I'm not looking for theory or some best practices that you can get off ChatGPT. I want stories. I want you to hear stories, real ones. Real moments where investors helped or hurt the company in a way that mattered. So we're going to focus on 2 questions. That's it. When did investors bring negative value? And when did they show up in a way that genuinely changed the outcome? No PR answers, no anonymous villain monologues, none of that stuff. Just concrete examples, what happened, why it mattered, and what it cost and or not. So here it comes. Richard, tell me about a time an investor made your company worse. What was the moment you thought, wow, this is not helping?
Yeah, thank you, Anil. And for background, I'm the co-founder and CEO at Voya Energy, a long-time background in the battery and energy space. So we have been deeply involved with corporates for a long time as well. I've seen the full spectrum of experiences. For context, my previous company, Cuberg, was an early investor, was Boeing Horizon X. I was actually at GCVI, I think 7 years ago at the invitation of Boeing, back when Horizon X was still actively deploying capital. Great to be back. And then later on, we were acquired into Northvolt, the large Sweden-based gigafactory scale battery manufacturer. So lots of in and outs of corporate exposure as well as VC exposure. I would say in terms of the negatives, honestly, especially pertinent at this event, I would say it's fair to say that the variability of experiences with corporate VC in particular is a lot higher than in the financial VC world. I would say for better or worse, financial VCs mostly stick to a fairly standard script and operating model of how they engage with entrepreneurs and the norms of practices and so forth. But in CVCs, I've certainly worked with corporates that have been enormously positive and valuable. And I've also encountered the other end of the spectrum with things that have really hurt the company. So I'll give you one example from actually my previous company back in the battery industry. Dominated, of course, by Asian giants out of China and Korea and Japan. We worked with a number of CVCs and Korean battery companies in our early days as a first-time entrepreneur, early stage. And I think one of the most challenging things we encountered was really the sort of idea of false promise and hope. The idea that the CVC would come and say, oh, I'm interested in your technology. I might come and invest in your company. I want to learn more about you, give us samples. I'm going to run you through this extended diligence process. And we did this with one investor that we're very excited about as a prospective lead or at least major contributor to our Series A funding at the time. But really what happened in retrospect almost destroyed our company. We almost ran out of capital because of this experience with this CVC. Basically because I think in retrospect what we realized was a lot of these, their activity was really focused on just mining us for information and doing scouting and open innovation, but not really wanting to partner, just trying to learn about the landscape, figure out new ideas, teach their scientists what's going on in the world, and using the motivation of luring capital to get entrepreneurs in the door. And so this sort of false collaboration, where it's really more about extracting value and information rather than figuring out how to engage, can really be damaging. I think it's better to just say, okay, this is not the deal for us, just say no, let the entrepreneur go. They can spend their time doing something else that's a lot more productive, but luring them into this long extended process that diverts them from a productive pathway can be enormously damaging. So I think that's kind of my story I wanted to share.
Cool. Paul, what's the worst board meeting you've ever had? When did you realize you were managing investors, not partnering with them?
It's a bit of an occupational hazard to come up here and say bad things about our investors in front of
You have to.
But yeah, so also just by way of background, my name is Paul Lambert. I'm the CEO at Quilt. We make the world's most efficient heat pumps for homes. So we're electrifying homes across North America, displacing fossil fuel systems and old efficient ACs, and freeing up energy and making homes healthier. I also ran a SaaS company earlier in my career. I was the CEO of that for 5 years. Totally different experience, based in Canada, different set of investors. So I actually do not have any CVC investors, though I've talked to a number, although I'm in EIP, which is not a CVC, but represents a number of corporate LPs that we do get business opportunities with. Worst board meeting I've ever had.
By the way, you can totally go after VCs as well.
I can go after VCs.
Yeah.
Well, you know what? I think I might spin it and just. I'm gonna actually like to riff on your last word, which is I think is getting the idea of like when can investors be disruptive value add. I will echo what Richard just said. Is that we had one in our last round, our Series B, who was a CVC who we met kind of, I'd say, more junior people at the fund. We thought they were genuinely interested, and then we finally met with I think it was the managing director and then maybe someone from the corporate side as well. And all of a sudden the vibe really felt like, oh, you're just here to get information. And when they talked to us, it was kind of like, yeah, we might want to acquire you sometime. Like, it was very kind of condescending. And in retrospect, it was one of the worst investor meetings I've ever had in my life. Just like, not just that it didn't lead to an outcome, it's just the way it made me feel and my team feel. It was like, why, A, you're wasting my time, and B, you're talking down to me. So that was an example of something that wasn't great in the CVC world. But I think the other one was, and this is all coming from a good place, but at the end of the day, investors have lots to do, especially, but at the end of the day, it's cash, right? I mean, at least for the financial investors, but CVC investors as well, right? That's kind of your value proposition. You have this commodity, and then you got to differentiate, but at the end of the day, the commodity matters. And something that was disruptive in our last round was our existing investors were really excited about the terms we'd be able to get, sort of the valuation, the terms, and we believe them. They're the investors, like they're the experts here, and sharing that back with our team and sort of projecting that same level of confidence. We ended up getting the round done, but it was less of a walk in the park than our first one was, and that created a lot of turmoil within the company as we had to then manage these expectations that we maybe took with less skepticism than we would have, because we felt like the investors were talking from their place of experience. Like, they're the experts in fundraising. If they say this is going to be, easily done at this round, we can believe them. So I just think that as an investor or a board member, you need to be really careful about what you're telling the entrepreneurs, especially when it's coming from a place where we expect you to be the expert, because of the downstream impact that can happen within the company. And people obviously get nervous about things if they think that fundraising is going differently than you expected. So those are two things I can think of where like it maybe wasn't the best investor experience.
Yeah, we're dream builders. You can't be dream killers, right?
Yeah, exactly.
It just seems ridiculous.
Well, but then the second one, it wasn't intentionally a dream killer. It was just like inadvertently causing thrash, right? Like if you're making a comment to the phone and oh, this is definitely going to get done. We'll be there for you no matter what at this price. And then turns out that's not the case. there was no malintention at the beginning, but it causes a lot of thrash. Yeah.
Yeah, have you seen investors just making introductions and not going to IC? This happens a bit, right? And then they realize, oh, actually we were not going to do our pro rata. Have you seen that?
Yeah, I mean, I think. Well, I will say, and I'm not just saying this because you're a partner of one of our lead investors.
I've seen that.
But we have good investors. Actually, I've never had one say we're going to do a pro rata and then they back out of it, or you make a commitment that they've walked back. But I know it happens. I don't know, Richard, have you had that experience?
Not for us, fortunately.
Okay,
Good.
We've been
Yeah.
Boeing stood up to their pro rata, and they bridged us when they needed, so they were a very good CVC, in my opinion.
Well, that's a great segue then. Let's talk about some happy moments here. What's one investor move that saved you months of time? Richard,
Yeah,
that's for you.
happy to take it. And I'll put a twist on this, but honestly, I feel I'd be remiss not to share
Yeah.
our story with EIP.
Yeah, sure.
It's not just, Anil's not paying me to tell this story, but honestly, from the bottom of my heart, it's how I feel. So the background of Voya Energy is a fascinating story, in my opinion, because I was introduced by Anil when he was still at TDK to Shail Khan, who leads the Frontier Fund at EIP. And it turned out that EIP was starting to think about incubating a first company of their own. They had never incubated companies before, a pure investor, but they looked at what were the space of metal fuels and got really excited by the prospects to really disrupt energy markets globally with metal fuels. And they sought out somebody to go and incubate this with them. So I was brought in through Anil's introduction to incubate for about 8 months together deeply with EIP. And I think the experience really changed my perspective of the value an investor could bring. And EIP in particular, I would say, stands out because of the enormous depth of experience on energy markets and just an enormous network of relevant companies, utilities, industrials, kind of the whole gamut of people that would be interested in this kind of a technology. And also with a great technology team to work with, we really sort of hand in hand built this company together from scratch, all the core concepts and technologies and so forth. And then at the end of the day, we got quite excited at what we found. We spun out, recruited a great co-founding team. And throughout that whole process, I think they were, really a trust-based relationship. Like, we didn't quite know how the spin-out would happen. It wasn't pre-contracted, but we had a reasonable arrangement. Both sides thought it was fair in terms of the equity split. We got launched. EISP has been super valuable in facilitating introductions across the corporate spectrum to prospective customers. I've honestly never experienced an investor relationship as positive as what we've had with EIP. I text with Shail on a daily basis to catch him up on things. It's just like such a positive and value building relationship. My co-founders as well feel the same. We've never experienced this before. And I would say, like, for VCs that truly know their markets and know their stuff, to go incubate and to lean in to work with us entrepreneurs, it can be just enormously powerful. Like, I don't think we would have succeeded in building this company without EIP, without the expertise and the depth that they bring to the table. So really appreciate it.
Thanks for the plug.
Yeah.
Same question?
Yeah.
Or-
Yeah, we could take the same question.
And it was,
Basically,
Not me.
what's an investor move
Yeah.
that saved you time and months or cost or something that they helped you with? Maybe provided additional clarity where something was down.
I have two things, and I'll try to keep them both quick because I know we're already running out of time. The first one was we did a major pivot of our business model, biggest strategic shift in the history of Quilt, about a year ago. We were originally a D2C company. We had installers on staff. We were operating a services business in addition to a product business, and we switched to a B2B2C model. So we now sell products into channel. Means completely walking away from revenue, laying off on a lot of people. Like, it was a complete shift in our business model. What was great was how supportive they were. I would expect, people just this a few months after doing a large investment round in a prior business model, you could imagine that being more of a boardroom fight, but it wasn't. They felt that, if we had conviction here that they were going to support us, and that was just knowing we had them behind us gave us conviction we needed to execute quickly. And I really think executing quickly was so key to be able to make that pivot and then grow the business to the point it needed to be, so we could continue to succeed.
Sorry, Paul, did you show them why you were changing
Yeah,
that?
for sure, for sure.
That helped?
But people were so into the prior model that, especially like
They probably
my
underwrote it.
co-founders, stuff like that, like, it took a lot of sort of people understanding. I will say one of the investors was kind of nudging us to start with to switch, so that helped. But still, Yeah, it wasn't a big fight, and that was amazing. And then the second one I think is just people, right? I think certainly as your company grows, as the CEO, like you spend most of your time recruiting and working on your leadership team, and that might be the board, that might be the executives. And if I look at my two independent board members that are both awesome, I would not have gotten them without our lead investors, also at EIP, Samir. But we have like Matt Rogers, who co-founded Nest, probably the most successful company ever in my space, and then brought in their former chief business officer and CFO of Sunrun, Tom von Ruckebauer. I don't think I would have been able to get them without the investors doing the work behind the scenes to get them to join the board, and they've been super helpful in just a million ways. Yeah.
We'll do a quick rapid fire because we've got 2 minutes. First question, what's the one reference question founders should ask about investors, but they don't?
Maybe a version of what you asked first. What's the most damaging thing you've ever done to an entrepreneur, and see if they have some self-awareness of, I made a mistake and I learned from it.
That's a deep one.
Yeah.
Yeah, I got to think about that. I'm sure I have.
Yeah. Too.
Richard, if you had to pick between 2 term sheets, what's the non-obvious deciding factor other than the price? Forget the price.
Yeah. Like the obvious things, that liquidation, preference, price, these are all things mostly of like, the company does well, how do you share the pie? That's the obvious stuff. But I think if you want to dig deep, it's like what happens when everything goes wrong. And like right now you're in a trusting relationship, everything is good, but there may come a time when you're fundamentally at odds, and I encountered some flavor of this sort of in the latter days of my acquisition within Norfolk, but when you can become over-constrained, politics come into play, maybe the board member that you trusted left the firm and now you have a new board member who you don't know and don't have the same relationship. I would say look at like what is the actual definition of termination with cause, and what are the implications of that for your equity share? Are they going to try to assert that you did something wrong at the company and claw back all the founder shares that you've earned over all the years working at the company? Like that's a deep thing in there, but if things truly go wrong, the people you trust are no longer there, like who knows how the investor might behave, and that's just really covering, I would say that's a non-obvious one for me. Last one, just a real quick rapid fire. What are the screening things that you do to investors? How do you screen investors? Who do I want on my cap table? I think it's really a personal trust thing, and I think trying to gauge how they do in honestly more difficult situations and asking them maybe some more uncomfortable questions of how they've behaved, I think to your point as well. Yeah, with a lead, I think of it more as hiring a board member or interviewing a board member. So you do the references, you think about the what success looks like making sure they're in it for the same reasons you are in the same time horizon. Because I think a lot of investors will get caught up with entrepreneurs where they have different expectations on different time horizons or outcomes. So I screen for that, and then of course reference checks, right? And hopefully back channel ones. Go find other entrepreneurs, look at their portfolios, don't tell them you're doing it, and go talk to other entrepreneurs that they invested in. Great. Yeah. Board members, someone you can't fire. Yeah. All right. I hope that was helpful for the audience. Thank you very much for the opportunity to discuss this topic. Cool. Thank you. Thanks, Anil. Thank you, Richard. Paul. Oh, right. Got it.